Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Hey, today on the show, I want to talk about an age-old question that has a lot to do with what's going on with the debt crisis right now. And that question is this: when's the right time to invest? When's the right time to jump into the market? I think many of us are thinking that right now, feeling the emotional side of the investments while we are looking at everything going on in the news, whether or not the government's going to actually find a deal here on the debt ceiling limit. We're going to talk about that today. But before we get started, make sure to go to our website at onecapital.com. You can click on our media tab and you can download and subscribe the Make Your Money Matter show. You can also download the podcast on any other platform you would otherwise download a podcast, whether that's the Apple iTunes app, SoundCloud, Spotify, or Google Podcasts. Do me a favor, leave us a review. Give us a comment. It helps us spread the word, keep the podcast going. And as always, we appreciate you listening. All right, let's get into it. In my topic today for this week on the show, I want to talk about, again, the best time to jump in the markets. And I was thinking about this the other day through some review meetings. And for many of you who know me personally, I'm a big surfer. I'm an avid surfer. I've been surfing most of my life since I can remember. My paternal father was born and raised in Hawaii. We've obviously lived there myself with our family. So the ocean and surfing have always been a very big part of my life. And I share it because of this reason. When we lived in Hawaii for a few years, one of the greatest benefits there was being able to surf at my favorite break, Honolulu Bay in Maui. And it's one of those breaks that's just a magical one. It's a top 10 wave in the world. It essentially has 4 breaks on it, especially when it's a north swell when it hits. It starts at keiki bowls right on the inside, then goes to caves, and then the third main one is coconuts. But right in between cave and coconuts is this place called The Point. And that's always been my favorite spot. Now, there's 2 ways to get out there. One, you can go through the beach break, which in Hawaii in general, you have to kind of go down this huge cliff and then out the beach break. But on The Point, there's this rock. It's about a 10-foot rock. You got to walk out to the edge of it, and then you jump into the water. Now, for anyone who knows surfing or just tides and oceans in general, tides and waves, especially when a swell is hitting, moves in and moves out. And I notice a lot of guys when they're jumping off this rock, they will wait for the wave to come up on the rock, thinking that when they jump, it'll be a soft landing, right? The water's up and they're good to go. Here's the irony, and I relate this to investing all the time. When I see guys wait for the wave to come up to the rock and then they feel like, okay, now's a good time, it's comfortable, it's not too shallow. When they jump, by the time they jump, it becomes shallow again, right? Because waves move in and they move out. Now, ironically, what I learned from an old mentor of mine is you want to actually jump when the wave is shallow. And I say that because by the time you jump, when the wave's shallow, that means the tide's coming and the wave is coming back in. And when you jump and actually hit the water, it'll then be the time, because that's when it's flush and nice and cushy for you to land on and then for you to paddle out. Friends, this is no different when we talk about investing, all right? You know, if we wait till it's always cushy and, you know, it's perfectly flat, ironically, we're going to then ride the wave back down. And I think this is a good analogy and almost, you know, metaphor or vision when it comes to the quote unquote best time to jump into the markets. And for any one of us asking this question right now, you're not alone. That's what I want to share. As always on this show, I like to prepare weekly common threads and synergies that I see in client communications, meetings that I have, you know, weekly. And I like to make this common thread so that just so you know that you're not alone. It's emotional. And I talk about this a lot. And let me give you an example of what this means. It's like during bear markets or volatility, your brain goes into a logical, I need to get out before I lose everything mentality. And then it's interesting because during bull markets, your brain then goes into, I need to get in now before I miss out on future gains. Hear me when I say this. The best investors, I've been around for 2 decades in my practice here at One Capital Management, are always stacking assets, if you will, especially when they're on sale. You've heard me say this many times. Volatility can be a good friend if you know what you're looking for. Now, when it comes to the question of when's the best time to jump in the markets, remember this. It's not about timing the markets. It's about time in the markets. And my analogy, my metaphor, when it comes to surfing and jumping off a rock into a wave, especially a heavy break like Honolulu Bay in my example, right? It's a lot like investing. Novices will buy at the high tide, but experienced investors buy when they actually see the rocks, when it's shallow, when most people are running for the hills. Now, as always, this isn't a blanket invest in everything because what I'm saying is gospel. No. You still need to be pragmatic. And that's where a counsel and advisor comes in. But I love this saying, and I heard it from Toby Rodriguez, my advisor partner here at One Capital Management. Many of you know him and work with him. He said this to me, and I'll never forget it, and I always loved this statement. Do what others won't so you can have what others don't. It's pretty profound when you think about it. Sounds simple in nature, much harder to do. And let's look back for a quick second and think of reasons to sell. Because in the next couple minutes, I want to get into our debt conversation, this debt crisis that all these news outlets are making us feel. And I'm not saying it's not a crisis or of urgency, but let's break it down a second. But before we get there, let's do a little bridge for a second. Think of, in the past, reasons to sell. Now, I could sit here for hours and tell you all the reasons to sell over the course of history, but here's a few that come to my mind, and let me know if you feel the same. How about this year, starting right now? Bank failures, that's a reason to sell. How about last year or this past 15 months, I've been talking about it heavily, rate hikes. How about 2021? We had supply chain issues, the beginning of real supply chain crises. 2020, how about a pandemic, friends? I mean, just going back just those few years, you can see every year there's big reasons to quote unquote sell. Going further, how about the repo market in 2019 or the trade war we had in 2018, or we had some major hurricanes, some natural disasters in 17. What about Brexit? Remember that? 2015, 2016, we had a huge Ebola outcry in 2014. Well, they deemed it huge, but the point is there was fear going on and reasons to sell. How about 2013? Guess what, friends? We had a government shutdown, 2 of them, in fact, in 2013. So what we're seeing right now, which we're going to talk about, isn't totally new. You can obviously go to 08. How about 2001? So, friends, what I'm getting at here is when we talk about the question of when's the right time to invest in the markets, my answer will always be this in very simple terms. Now, I'm not saying that, again, that you need to move everything around and invest everything you have. Again, planning comes into place. But a very simple answer is to avoid the noise. And the answer is now. Because let me be very clear about something. No one has ever grown their assets or grown their wealth by sitting on the sidelines. And if you are there right now, what happens most for people is understanding my saying of it's not about timing the market, but time in the market. Don't try to rig the system for yourself. Understand that it's about action. And that's ultimately what gives you the satisfaction.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Something I realized too, the other night I was playing Monopoly actually with Brooks and Kate, my 7-year-old and my 5-year-old. And I don't know about you guys out there, but that was the game my family and I grew up playing. I always loved that game. And to this day, it has so many life lessons. But I find that when I play it in different seasons of my life, I learn different things. And this dawned on me about 4 nights ago. Brooks and Kate and I are sitting down at the dinner table. Veronica's just finishing up dinner. And before we ate, we all 4 sat down for a little bit as the food was cooking to play a quick round of Monopoly. Now, we all know Monopoly's not exactly quick, but to my kids, we adapt the changes a little bit to make it quick for them because their attention span, as we all know, isn't very great at 7-year-old and 5-year-olds. But here's what I realized that night, and for some reason it just dawned on me. It taught me this, that if you don't take risks, you'll end up paying rent to someone who did. Let me say that again. If we don't take any risks, we'll end up paying rent to someone who did. Your actions today have a lot to do with what's going to happen for you tomorrow. There's a lot of noise. I have no doubt about it. But understand my old saying, as always, right? It's the noise around a ship. It's the water around a ship doesn't sink it, right? It's the noise, it's the water that gets in that sinks it. So filtering it, and this is where counsel comes in. This is where an advisor comes in. Has a lot to do with it. It's been said that the stock market is a barometer and not a thermometer. You ever heard that before? It means the price of a stock today is not established by, taking the temperature right now of that company today, but by anticipating the temperature of that company tomorrow. The market looks at the barometric pressure, if you will, on the company, and then tries to anticipate how they will affect the temperature a month from now, a year from now, and so on. Wall Street, if you think about it in many ways, acts like a weatherman sometimes. Our opportunities for gain come from being able to recognize when the weatherman is wrong about a certain company during volatile times. Again, bears sound smart, bulls make money. I say that at the end there because that comment actually came out in a conversation I was having with someone the other day. Because many of you out there, look, it's okay. Let's be honest. We follow people. We read newsletters. We subscribe to certain things. Be mindful of what you're reading and what you're subscribing to. Is it fear selling? Again, I'm not saying it's not factual, because you can make a side for anything nowadays. My point is this, are they sounding smart, but are they actually tried and true methods to what their portfolios can do during all time periods, not just volatile time periods? And speaking of the debt situation we have going on, I've spoken about this a couple times in the past few months. In fact, about 2 months ago, I did one of our shows around what we knew was going to be coming up with the common theme over this quarter of being the, debt crisis that the news is calling it. So here's the $1 trillion question, friends. Can the US government ever have too much debt? Yes. The real and hopefully eternal question is exactly how much debt is too much. Nobody knows the answer to that, but with confidence, we feel here at One Capital, I want to share some insights, we're not there yet. The US has carried debt since its inception. Remember this, okay? Debt incurred during the American Revolutionary War at that time amounted to $75 million. Those were the days, right? That sounds cheap in comparison. As of March, end of last quarter, which is end of quarter dates, our last most recent one, March 2023, it cost $384 billion to maintain the $31 trillion debt, which, if your math whizzes out there, is 12% of the total federal spending. The average interest rate the U.S. pays to borrow money, again, this is as of end of 2022, is 2.07%. Now, from the example I just made, though, with normal economic growth of 4%, there's plenty of growth to cover the cost of borrowing. I want to share those stats simply for context as you're watching and reading and listening to everything going on with the debt crisis. Understanding that gross domestic production and overall economic growth, national economic growth, relative to the debt they're paying, if there's spread there, we're okay. And I've said this before, I don't have an issue with raising the debt ceiling. I don't. And frankly, I think we need to. But here's what I do have an issue with, is if we don't learn from this mistake, we will end up repeating it. We do it in our own personal finances, right? If we get to a point where it's stressful and we have too much debt and then we have this nice relief of being able to consolidate or pay it off, or maybe we're working overtime and we're doing all the things in our life to structure it, we're less inclined to get back into it because we know the pain that it inflicted. And I just pray and hope that if and when I think we do raise the debt ceiling, we'll be able to learn from this and curtail our spending. Remember this is true of your personal finances and this is true of our government debt. Debt itself isn't the disease, it's the symptom. The underlying disease, if you will, is overspending. We need to fix that, not the debt. Everyone's focusing on this one thing, this symptom, right? Focus on the symptom. What's the root cause of it? That's what I'm hoping for. And that's what I know as a firm we're studying. And I think all of us as voters out there need to look for those fiscal responsible environments. And remember this, raising the debt ceiling allows the government to service debt it already has. So defaulting, as what they're selling right now and as a fear situation, obviously can disrupt financial markets. We've been seeing it, even the negotiations, we've been seeing some, volatility. And it'll likely punish our retirement plans and investments, maybe downsize or capsize businesses and take jobs. For better or worse, it has to be raised. This is my point, because we can't have those situations. Congress, at least the vast majority of its members, knows that. I think, again, a more useful debate after the debt ceiling is raised is how to make the government more fiscally responsible. Let me end on this. Debt is fine, often good. I've shared this a lot. I differ of the Dave Ramsey. I love his methods, especially his spiritual and eternal methods of how we are to steward and look at money. But I differ on this one logical and practical situation around debt. If you use it correctly in the right forms, debt can often be a good thing as long as there's an ability to service it. So as all these conversations are coming around, I want to remind you of this. Stay the course. Think long-term and be disciplined. And yes, I mean that whether or not you are in your 20s or 30s listening to me, or in your 60s or late 50s maybe, and you're retired. Because God willing, the same amount of time you had while working during your working years, you have in retirement. So understand that long-term still applies even if you are no longer working, maybe on a fixed income, and retired. I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. And again, if you'd like our help, you can reach us at 805-410-5454. And always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.